The fall of 2008, there was a significant change in the pattern, a significant reaction to this crisis. And even though we were out of the crisis mode here for a while, you can see toward the end of this chart in 2010 that we're already beginning to see this signs of the crisis reemerge. And I hate to say that this is where kind of we are headed, but this is going to have a very significant on the corporations you work for and corporations in general. Let me kind of now turn the program over to Wolfgang and Corey to kind of have the real world perspective on what's going on.
Okay, great.
Wolfgang?
Thank you for that. I mean, I think that you make some really valid points there. I mean, looking at the way that the money was spent in Europe to stimulate the economies, you know, even the ECB has come out and said we didn't do a very good job at that, which is why you see these huge rises. Then add to that not just Europe and the possibility of it certainly not being the euro, in our opinion, is not going to be where it is today in 18 months. Whether it'll be a different constituents, it'll be different value, and quite frankly, there won't be every one of those countries, in my opinion, isn't going to be in there. In next 12 to 18 months, you saw some great trigger points there with Greece, possibly. You know, I wrote an article not too long ago talking about how G of Greece is not the last letter in pigs, and I still think that, you know, there's going to be a significant political impact again on Germany when things like Spain are going to look to refinance. You now have Hungary, though obviously not in the euro. You got Switzerland having to already intervene because their Swiss franc is increasing too strong. So to your point then about the volatility continuing to increase and staying at those levels that we are today is certainly impacting corporations and quite frankly the value of these companies, because obviously people get valued on the predictability of what they're reporting and looking forward. So as foreign exchange now is impacting corporations, you got to look at foreign exchange as an economic risk to companies, and then how do you address that and where do you go from here? So obvious place where everybody looks at and how people look at the valuation of companies is looking at the income statement. So as foreign exchange impacts the income statement, it does so obviously on a lot of different lines. Above the line, summing up to the net operating income, you've got revenues being less predictable because at the end, what is actually going to be the value of that revenues? What are the cost of goods sold? What are the operational expenses? These are true economic impacts. I know there's sometimes still this laggard background thinking about, well, this is only accounting. No, this is not, as you know, we've discussed many times, this is not accounting, this is economics. This ends up in the bottom line. Either you have money or you didn't get the money. If you sold something for 100 euros, you know, a few months ago you would have gotten $160. Now you get $120. That's impacting your bottom line. That's $40 you're not having. So then people look at the below lines from net operating income, getting to the net income, trying to look at translating their balance sheet, looking at their accounts payables, their accounts receivables, their intercompanies, and all this stuff. And people say, well, that's all accounting. And yes, people at first look at it, but that accounting ends up whether you end up having cash or not. So even from the foreign exchange gain or loss, if you have volatility in there, it reduces the likelihood of you making something or creating or adding or getting to your earnings per share, which obviously that part is in your earnings per share. Less predictability in earnings per share are obviously creating less shareholder value. People get nervous about it. So, but what are we seeing as we've talked to analysts and said, what are they saying about this? And what we're hearing is that if people have unexpected foreign exchange gains or losses, they really are signaling that there may be some lack of risk management expertise, maybe a lack, as we'll talk about in a second, to visibility towards certain risks, less predictable margins, less predictable net income. So therefore, as we just mentioned, less predictable earnings per share. Yep. In our opinion, and what we're seeing is you're going to see in July, when you're starting to get into your earnings seasons, a lot of corporations having unexpected foreign exchange results. And that is going to create additional volatility, quite frankly, in the equity market. You're already starting to see some companies trying to manage, obviously, expectations of Wall Street. So, you know, you just had Priceline had come out. They looked very good for Q1 from a revenue point of view. but they warned about declining due to the euro impact.